Today has seen yet more drama in Chinese markets, with sharp falls triggering an early close for the stock market, second time this week, and fresh 5-year lows offshore for the Chinese renminbi. With me, I have Mohammed Apabhai, Head of Asian Trading Strategy at Citigroup. Mohammed, what's going on?
Really what the concern is about the Chinese economy, the weakness that we're seeing over there. The Chinese are finding that increasingly the avenues that they've got to control their economy are being shut down, especially as there's been competitive devaluations by other countries across the region. But why this matters more than anything else is because this is crucially important to the question of whether China manages to avoid the sort of credit problems that people are really concerned about. The second question, why this is more important from a global perspective, is whether China actually manages to do it by exporting deflation to the rest of the world.
Now, from what you're saying here, I get the sense that the currency matters more. There's a lot of attention paid to the stock market as well. Why isn't that such a good gauge of what's going on?
Well, the stock market is really a barometer of what is going on overall in terms of the economy. So the fact that, for example, the HSCEI,
the Hang Seng China Enterprises Index,
correct,
basically 8 shares,
8 shares
yes,
in Hong Kong is now at a price earnings ratio with a 5 handle, is interesting. It basically means that people think that the earnings of major state-owned enterprises, major banks, may actually fall quite substantially. Interestingly enough, though, today, while equities are down 7% in the mainland, China credit is actually up, holding very, very stable. It's a bit of a conundrum as to exactly why that's going on, but we think that the credit market will also react fairly soon.
The PBOC, the People's Bank of China, is key to all of this because of the way it fixes the midpoint around which the onshore currency trades. Now, we've become fixated with this daily fix. Are we in danger of overinterpreting what the PBOC does every day?
I think we're only in danger of overreacting to it as long as the market stops reacting to it. The problem at the moment is that, for example, this morning, what you saw was the PBOC fixing 5 points higher, and immediately futures started falling. Now that was not only in China. A-shares actually started with the S&P futures. Now the other thing that is happening is that the Chinese came out with a statement around lunchtime today saying that this is nothing really to be concerned about, that this is in line with the new band, the new basket weight that they've got, and that really giving an indication that this is actually a trend which is set to continue. And that is something that the market is really very worried about. What people are concerned about in the immediate short term is the way that the forwards are moving, not only in the renminbi, but also in some of the other pegged currencies, like, for example, the Saudi riyal. Now, of course, we know what's been going on with the oil price and the impact on the budget deficit in Saudi Arabia. But what is less well known is that the Saudis, as well as the Chinese, actually own portfolios of equities across this region and probably across the world. And if you're in a position where you're seeing foreign capital outflows, then one of the concerns is that what they might be doing is actually trying to mop up some of those capital outflows by liquidating some of their assets.
Bringing it back to Asian markets for a minute, obviously China has a particular importance in this region. Where do Asian markets go from here? They've had one of their worst starts of the year.
Our view is still that markets are going to go lower. Japan is a potential hotspot because people own it, and also it will be hit very hard by deflationary forces. India is another market which is very well owned, even though deflation theoretically is a good thing for them. But if it's a generalized risk off, it's not going to be good for them. Taiwan is another market which seems to be very well owned by sovereign wealth funds. The market that we're very concerned about is actually the HSCEI in Hong Kong. And the reason for that is not really anything specifically to do with China, but is to do more with the auto-callable structured products that there are in the market, which will mean that if the market starts selling off, what you will actually start seeing is future selling.
So it's not just about China's impact directly on Chinese economic growth and what that does for the region, but about the cross links between different countries and different markets.
If you woke up tomorrow morning and you saw the HSCEI down 12%, if you didn't know about these auto-callable products, what you would automatically imagine is that this is it. This is the big China credit crisis that everybody's been waiting for, when actually maybe nothing of the sort. But as we know, these things can often feed back on themselves. And this is really our concern, that if you get down to the September lows and there is no action, I mean, remember September lows was really where the last action was, and you don't get any action, then markets may start thinking, well, this may be the beginning of something which is a lot larger. The last low was on September 29th, which was 2 days before the start of the Chinese Golden Week holiday. So basically, the way that we interpreted that was if it was Chinese people who were selling, they didn't want to be around over their Chinese Golden Week holiday to sit there booking trades when they should be out there having fun. And so basically with Chinese New Year around February the 6th, the end of January, start of February may be an interesting time for maybe calling a turn in the market again.
I have a feeling we'll be talking a lot more about China in the coming weeks. Mohammed Apabhai, thank you very much.
Thank you.